Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah. The talking point today are the views of Andrew Holland of Avendus. We've got the right guest today in the midst of all the global moves that are happening to try and understand what's happening there and the impact thereof on EMs in India as well. Andrew, great having you. Thanks for joining in.
Always a pleasure, Neeraj.
Andrew, I saw your tweet yesterday with interest. You are talking about maybe a 25 basis point hike in rates on 22nd, or maybe the Fed going on pause as well. But effectively, we're moving towards the end of Fed tightening now. No one thought that the Fed's hands could be forced. You think this event kind of does that?
Neeraj, I think over the past year or so, we've talked, extensively about this, and that, we just didn't know the kind of sharp rise in interest rates over the last 12 months, what unintended consequences it could have. And obviously, we're starting to see those. And that's brought the fear gauge up for equity markets. Obviously, if you listen to people or speak to people in the US, everyone over the weekend was saying, is my money safe? No matter what bank, they were in. So that fear has to be kind of quelled or quashed. And, that's what the central bank tried to do over the weekend. Now, you could say, well, that's not really, not playing out so well, because the regional banks in the US, have also, seen their share prices fall significantly overnight. But that's a factor of this. One is, as an equity holder, you know that the bank will be saved and the deposits will be saved, but your equity won't. So I think people are just saying, listen, I'm not willing to take that risk. I don't know. So what I don't know, I'm going to move out of that stock. So I think the central bank has a few more days of just kind of ease the nerves of investors that, this is not going to be, more contagion from where we are today, because obviously we all start thinking about 2008 and then the property markets and the housing markets, which have seen significant rises in house prices, in the US and elsewhere. So I think the Fed has got this problem now. If it goes too aggressive, it's going to hurt, the banking system, the confidence in banking and lending, and that's going to have its own impact. So what you saw yesterday was the 2-year bond yield falling very, very sharply. And there's two parts to that, Raj. One is the fact that the Fed will probably do 25 basis points and then go and hold to see what else is out there. I mean, that's the expectation we have. Or it's telling you that the hard landing is coming. And that would also indicate to the Fed that, they should probably go on pause as soon as possible, to kind of keep the system running. Maybe they'll cut down on the kind of quantitative tightening in terms of the amounts of money, just keep liquidity there in the very short term. But obviously, the outcome of that would be us all thinking about, inflation remaining high, and growth starting to falter from an economic viewpoint, which obviously is stagflation. So that's the other factor that the markets will worry about. But at the moment, we just need to get through this. So I think the Fed is kind of there or thereabouts. The damage is being done. The economy will slow, and that will bring down inflation at the same point. And it's something that we've been saying for some time. It's just the sequence of events, is always a bit quicker than you expect in terms of these factors.
Yeah. So Andrew, that's my question then. From a risk asset perspective, we've seen the flight to safety to US bond brings the yield down. Ordinarily, the markets would rejoice such a thing, just that the nature of events doesn't let the markets do so. But the point that you made, which is that while this may make the Fed not do what it otherwise wanted to do immediately, the bogey of inflation is not dead as yet. You could argue that if the startup world slows down in the US, if there are layoffs, etc., it might have that first round of large impact on inflation. Is that a thing that you would preempt, therefore? And would that be constructive? Or would you, as you said, the markets believe that inflation, even if it comes off, might still be higher, and there might be a hard landing, and therefore we're looking at stagflation, and which could be actually worse for equity markets?
Yes, and obviously that would also mean that earnings forecasts again would have to be revised downwards, and I think that's the point. Whichever scenario, look at the hard landing, stagflation, and therefore markets. Just take the European markets. Everyone was saying, "Oh, they're falling quite sharply yesterday," but don't remember what 2 weeks ago they were hitting all-time highs. So you're coming off the top. It's not as though you're coming sharply kind of whistling through the kind of lower end of the ranges that we've seen over the past year or so. So I think that's one of the factors to also be aware of. And obviously the bonds falling where they have done will give some relief to those corporates as well, right, holding any bonds. So I think the Fed will be cognizant of that. Obviously we have some inflation data, I think today or tomorrow. That will give us some more clues. But the bets on 50 basis points of, I've even seen someone say a cut in interest rates this time. I don't think that's going to happen. But what I suppose what we're trying to look through is that the Fed will go on hold sooner rather than later. Yes, they might keep rates a little bit higher for longer to see how make sure that the impact is having on aggregate demand, and therefore inflation is starting to pave its way through. And obviously with China reopening, you've got the supply chains coming through as well, which again will help drive down inflation. So our view has always been inflation will come down, and that the Fed will at some point go on hold, which looks now quicker, and that will be the point of time when investors will, once things settle down, will say, where's the growth going to come from? And we spoke about this before, and it's going to come from emerging markets going forward. But it's become very consensus in that respect. But that's when I would feel that the money flows will come into emerging markets.
So what does that do for an emerging market like India? Two-part question, actually two-factor question, Andrew. We've seen the first signs of a cool-off in India inflation. If anything, the belief is that there will be disinflationary pressures moving ahead, and that might actually help the headline and the core inflation data as well. So does it kind of help the RBI to do what it may want to do, because Indian jobs data isn't that strong, part one. And part two, with the fact that we haven't moved at all on the headline numbers now for the last 15, 18 months on aggregate, the valuations are closer to the long-term averages, not quite there yet, but closer as opposed to being 2 standard deviations above. Does that make Andrew Holland deploy the cash that he's been sitting on?
So in terms of the RBI, I think the RBI has been really following the footsteps of the Fed, to be fair, and I think that will continue to be the case. I think whilst we might diverge a little bit away from the Fed, because obviously growth is starting to slow in India. You're not seeing that private capex cycle picking up just yet, and obviously these kind of events as well will not help sentiment in the very short term. And the government have really yet till next year will have to kick up their capex plans as well. So I think the RBI will tread very carefully. Would they go on hold? Possibly this time around, just to see how the impact is of some of these events. But that's some time away, so we can see what the Fed does first on the 22nd of March. As regards flows to India and so forth, well, whilst you're right that the valuations have come back to more towards the kind of mean, I think in this first half of the coming year, you might see just some more earnings downgrades in certain sectors because of margin pressures and lower volume. So I'm not saying that it's going to be significant, but it could be a case again this year of 2 halves. First half of not seeing much flows because there are cheaper markets in emerging markets, but as growth starts to pick up in the second half of the year, on the basis that government capex and private capex starts to pick up, then that's when we'll start to see again those earnings upgrades start to kind of come through again, and that's where I think we'll get the flows. So may not get the flows in the first half, or we will get some flows because of our weightage. But I think most foreign investors are taking a more underweight view on India at the moment, because great performance over the past 2 years, and there's cheaper markets out there when you're looking to kind of look the growth going forward. So therefore, it might be a second half revival in terms of FII flows and sentiment towards their weightage.
Second half calendar 23, you mean? or
Yes.
FY24, calendar 23. Okay. So Andrew, from your perspective, because you're such a large money manager, and last time that we spoke, unless I'm wrong though, if my memory fails me, you were still sitting on some bit of cash. Are you still doing that and biding your time, or are you selectively starting to deploy, discounting what could happen 6 months out?
So Niraj, we've been sitting on, we haven't really changed our cash levels, to be fair. And the reason for that is that the past 2 months, the volatility in the market has been very high, and it's been very rotational around sectors. You have to be very quick to capture the kind of sector to sector rotation each and every month. So when that happens, it's just a bit difficult to kind of make money both on your longs and your shorts, because you get squeezed on the short side as well. So we've just been keeping deployment levels lower than we would like, until we could see some real catalyst to move the markets one way or the other. After the budget, we thought markets would move, and then obviously there was other events that happened just around the same time, which dampened the sentiment. And obviously these kind of events globally will keep sentiment on the sidelines. So there's no real catalyst at the moment. We have to wait till the 22nd, and I think that's what everyone will do, unless the Fed comes out and says, before that we're going on hold. That would be a different scenario altogether.
Got it. Andrew, again, a two-part question, because I don't know whether you'll have a view on the first part or no, but I'm asking that to you any which ways. If you don't have a view, you straight away skip to the second part of my question. Part one of my question is the Hindenburg-ADANI row, from a global investor's perspective, behind us now, or could there still be some after effects felt? Part one. And part two, again, from a global investor's perspective, Indian banking, while we've seen serious outflows in the recent past, and the positioning doesn't seem to be strong, would you reckon that Indian banking is relatively a lot more insulated than the issues that we've seen on the global end currently? And therefore, would these dips be opportunities to invest into high quality banks?
So yes, I agree. I mean, the banking sector has been hit by the sentiment surrounding the Adani group initially. I think that's settled down now. But obviously sentiment, just in the whole banking sector, you can't walk up a down escalator. There's going to be, fears about the Indian banking sector by foreign investors, whether it's right or wrong. It's just that, they will be told, risk off trade. Let's move out of any banks which are not, where that ratings may be high or whatever it might be, because there could be some kind of fall in share prices from there. But otherwise, the banking sector, as we've said, is really kind of cleaned up its balance sheets. Corporate India's cleaned up its balance sheets. So I don't see that kind of risk, that we're seeing elsewhere. I mean, if you take the Silicon Valley Bank problem, it's all about a asset management liability mismatch, rather than anything else. It should have been picked up by the regulators, I would have thought, but obviously not. I think since 2008, for the large banks, both here in India and globally, I think the RBI has been very much on top of what they've been doing, and with the constraints that they have in terms of how they manage their funds as well. So yes, there will be some hit on the bond markets, but I don't think that's something I would worry about, because if you're coming towards the end of the interest rate cycle anyway, these will be reversed over time. So I'm less concerned about the bank. So I think it's probably an opportunity to start nibbling away. But I think we just probably would wait for a few more days, just to get that sentiment kind of globally a little bit more kind of stable, before, again, if you miss the first 5%, it's okay, right?
Yeah. So tactically makes sense to wait. The question that I have though, Andrew, and that's something that's become a talking point this morning because of the brokerage notes, and that is Indian IT. Now, BFSI globally, a large set of clients, that is under a bit of a cloud. Stocks are reacting duly today. What's your sense? Indian IT.
Yeah, no, there's going to be a knock-on effect, obviously, because you're talking about the whole of the kind of ecosystem of technology in the US, being hit in the very short term, and that will have an impact, a sentiment impact. Again, I think these are more opportunities than I am so worried about. Yeah, I mean, it might trim earnings slightly, but if the share prices continue this kind of fall, then it would have reflected that already. So again, along with the banking sector, I think IT is becoming more and more interesting. Let's not forget that once interest rates in the US are on hold, and then the expectation is to fall, then everyone's going to look for growth. And obviously, tech in the US is going to be a growth area, right? It's not going to stop. With all the artificial intelligence, ChatGPT, that's not going to go away from us. So there will be big opportunities going forward for enormous growth in this area, and which our IT companies will be part of as well. So it's really kind of gauging when to kind of dip your toes. But I think if we see this sentiment impact rather than an earnings downgrade, which is probably coming, but once that's priced in, then the next part is once the Fed goes on hold, what next?
And the last couple of questions. The last time that we met in a studio setup, which was pre-COVID, of course, you had correctly timed the growth in staple companies in India by virtue of the conferences that you attended or otherwise. Now, my question is, I'm hearing a lot of talk from economists about how less concerned they are about rural growth for 2023. If anything, they believe urban discretionary might come off. And therefore, if you put two and two together, some margin tailwinds because of lower raw material costs, and if rural comes back, then staple companies could well make hay in 2023. Is that a reasonable assumption, or you would not agree?
So it's a Goldilocks scenario for the FMCG companies if that happens, Niraj, isn't it? Because yes, slowing urban consumption overtaken by rural growth, it doesn't not naturally kind of go that way. I think the urban consumption, domestic consumption, will continue. It might slow in some areas, but I'm sure you do when you go to the airports. Everything's full. All the airlines are full. All the hotels are full. Speaking to a friend the other day, they said that just to get a hotel room, was costing 40 to 50,000 rupees in Mumbai a night. And people are paying it. So yeah, that might slow down. Don't get me wrong. But I think if I was to look at FMCG, I'd say yes. I think there will be some margin pressure, even because volumes will slow, even though they're getting those input prices. So where would I look? I'd look at the kind of companies which are in spirits. I'd look at companies which sell tobacco and fast food. I think that's where consumption will remain strong going forward.
Not hotels? I mean, just wondering, what's the view on hotels?
No, sorry, because we're talking about FMCG, but yes,
okay.
Yeah. So yeah, service sector, hotels, airlines are going to continue to benefit from this. I'm not saying. I think we're all wanting experiences these days, Niraj, after COVID, and I think that's not going to stop. I think people will continue to want to do that.
Yeah, I must say, Andrew, just before we wrap up, we had conversation with the top 3 hotel companies: Indian Hotels, Chalet, and Lemon Tree, and all 3 spoke about how rates, if anything, will move up and not down, and no supply coming in for the next 4 to 5 years. Doesn't seem like a pocket which will let go of its earnings in a hurry, never mind how cyclical it is. My final question, Andrew, because you will have a keen eye by virtue of maybe your private investments, but also the firm that you work for, is the SVB issue a Lehman moment for the startup world?
See, it could. It's difficult to. It's a broad brush in terms of what I'm going to say here. Particularly in the US, I think obviously for a lot of these companies affected, yes, they got cash, which is why they're waiting for their money back from SVB, and hopefully that will come quickly. But it might just slow down their thinking in terms of how they deploy their cash, how they expand, and obviously other banks which take over from this. I'm not sure the rates they were getting from SVB, so it might just slow the whole kind of expansion side of it in the very short term, and that would obviously affect many people and employees of those companies. So it might have that impact at the kind of venture capital, private equity investments, where I think everyone's going to anyway. People were, investors were saying, we want to see profits before we start investing, right? I think we've got to that phase, and I think everyone now will say, okay, not only do you want to see profits, we want to see cash flow, and where you're deploying that cash, and what's happening with it, and are you insured for that? How many banks do you have, and so forth and so on. So I think that would probably lead to a more kind of balance sheet management from these companies rather than expanding the business. So it might just take a few months for that to kind of play through as well.
All right, Andrew, thanks so much for taking the time out and giving us the wisdom. I really appreciate, and looking forward to have you or talk to you more often on the platform.
Thank you very much for this opportunity.
The pleasure was ours. Viewers, thanks for tuning in.